Welcome to Quick Takes. My name is Michael Antonelli. I'm a market strategist in Baird's Private Wealth Division. Today, we're going to be talking about a topic that seems to be coming up over and over again. Customers ask their advisors about it. Advisors ask me about it. It's a topic that I think will be asked for years to come, and that is inflation. Let's have a quick talk about inflation. What's important to know about it? How should you think about the various measures of inflation? What can you do if you're worried about inflation? I brought along my friend Ross Mayfield. Ross, how are you?
I'm doing good, Mike. How are you doing?
I'm doing great. Listen, there's nobody else I'd rather talk to about inflation than you, so I'm excited to kind of get going here. Let's just kind of define inflation to begin with in real simple terms for ourselves and for the viewers here. So, the Federal Reserve, which is the entity that makes interest rate policies in our nation, looks at something called core PCE. Core PCE. It's a really fancy sounding term, but it's just the kind of core consumption expenditures of a consumer. And what you'll see on the screen here are the various numbers that they have been for the past few months. So right now, core PCE is running at about 1.5%. So the Federal Reserve that sets our interest rate policy looks at inflation and says it's about 1.5% right now. You might say, well, that seems really low. I mean, that seems low to me. What are they looking at? Does that include all the things that I eat and the gas I put in my car, all that stuff? So core PCE does not include food and energy. Let's look at a measure that actually does include food and energy. Let's just look at CPI. So CPI is kind of all urban consumers, a basket of goods, including energy and food. And this is a look back all the way back to the 1970s of CPI, inflation, if you will, the US inflation rate. And it's running about 1.68% right now, according to this measure. Now, Ross, I'm 46 years old, so I'm a Gen Xer. I've never really lived in a world that knew much inflation. Have you?
No, I'm 29. I'm a millennial, as much as that term pains me a little bit. And not only have I not known inflation in kind of my professional career, but we've been trying to find it, trying to get it, and have been unsuccessful. So same here, completely.
Yeah, Ross and I have never really thought about high inflation. It's never been a part of something that we've considered. Inflation, as you look at this chart, has only fallen through time for us. But there's something I truly believe about investors in general, and that is they are products of when they kind of grew up as an investor. They're products of their formative years, call it their 20s and 30s. If you grew up during the 70s, you saw inflation, you saw how bad it can get. And that's probably one of the reasons Ross and I don't really think about high inflation. We didn't live through it in kind of our formative years. So, but inflation is an average. It's an average. Some things are going up, some things are going down. Ross is going to talk about that on what many people consider to be the chart of the century.
Yeah, I think it's important to remember that it's an average because there's power there in the fact that it kind of takes everything in our world and sums it up in one metric. I mean, that's useful in a lot of ways, but in a lot of ways, other ways, it obscures what's really going on. So this is, kind of sectors of the economy broken out since 2000. And as you can see, several items are incredibly deflationary. Technology has been an incredibly deflationary force in our world for things like TVs, cars, clothing, cell phone, even things that might not necessarily seem technological in nature. But then on the other hand, there are certain expenses and certain costs and big costs for a lot of people that are well above what the average hourly wage increase has been. And that's things like hospital services, things like college tuition and textbooks, medical services. So inflation is an average and there's power there, but it also can obscure where maybe your personal costs are. And that can really skew your personal inflation rate a lot. Before I pass it back to you, the one other thing I want to note here is that this period encompasses 2010, 2009, when we, for the first time, unloaded some historic monetary policy that sparked inflation fears, sparked a lot of people talking about inflation. Well, if you look at most of those lines, they don't really blip around that time. I mean, the forces that have either generated inflation in certain sectors or created deflationary pressure in others weren't really moved by that policy decision. So when we talk about why we're worried about inflation now, money printing and the COVID stimulus, it's important to remember that the stimulus in 2009, which was historic at the time, didn't really alter things too much either. So, I'll pass it back to you to keep chatting, but I do think that your point is right. The average piece is important to remember.
Some things are going up faster than others. That's kind of what Ross just said. That's how we want you to think about this. You might be a retired investor. You might be somebody who's in their 60s, 70s, and 80s. And you might say, it's the cost of healthcare is going up. And we know, like, this chart shows that. I'm saving for college. I know that the price of college is going up. There are some parts of inflation that are going up, but others are going down. That's what we're saying when we say it's an average. We're not concerned about hyperinflation due to stimulus, and we're going to get to that in one more slide. But first, let's say that the measures we're using right here are, you still don't agree with them. The CPI, the core PCE, you still like, I still don't believe, kind of the measures that they're mentioning to me. Let's shift gears and say, what is the market saying? We agree that the market is composed of all the expectations of its participants all over the world. So it's an entity that kind of takes in every expectation and spits out an answer. There's something called the 5-year break-even rate, and we don't need to get into kind of what it is, but essentially what it says is it's the market's expectations of what the average inflation will be over the next 5 years. What is that? It's about 2.5%. That's what the market is saying, not Ross, not me, not CPI, not core PCE, not the Fed. The market is saying it expects the average inflation to be 2.5% over the next 5 years. That's not hyperinflation. Is that higher than it's been in a while? Yes. Yes, it is. There is the potential for a spike in inflation as we leave our homes. We have a bunch of stimulus money in our pockets. There might be a spike in the cost of a restaurant bill or a hotel stay or an airfare. But the Fed thinks, and the market thinks, that will be a kind of one-off spike in inflation. They would want to see sustained inflation for a while before they change their view, right, Ross?
Year over year over year over year. That's the real inflation where it becomes a problem or a concern that the Fed needs to address. This, little blips in inflation in certain sectors here and there are not going to worry them.
So we'll just kind of wrap up with our final takes here as we wind down this kind of quick video. I want you to remember, I'm going to take the first two, Ross will take the second two. Inflation's an average, okay? It's an average. Yes, there are things that you might be interacting with, such as healthcare, where prices are going up faster than normal. Yes, but there are things that are going down. Again, I can get a really nice TV for $300. That my first plasma TV was $2,000. So the cost of some goods is falling, some are rising. Inflation's an average. And second, the United States is not going to have hyperinflation. Okay, I just want to get that out there. The United States is not going to experience hyperinflation due to money printing, due to this stimulus that we're putting into the economy. Hyperinflation, if you use history as a guide, typically happens for 3 reasons. One is output destruction of an economy, just the goods and services, ability to produce goods and services just gets destroyed. 2 is wars, like major wars, right? And third is some sort of regime change. A government changes the way it manages its people. The government changes its style of government. If you think about Venezuela, hyperinflation, they had a regime change. They changed the style of government. Think about Germany, kind of the end of World War I, that Weimar Republic. War, regime change, output destruction. They also were forced to pay back war reparations in gold and in other currencies. Hyperinflation is not caused by money printing. Governments end up money printing because they're in hyperinflation. So I want you to know that. People that are telling you that we're going to have hyperinflation and are just trying to scare you. They're trying to sell you something. Ross and I are here to sell you peace of mind. So Ross is kind of wrap up for us here.
Yeah, I'm not selling anything. But all that taken, people are worried about inflation. There are concerns, and the things that you can do if you're a little more worried, you can take some portfolio positions that are good hedges against inflation. Things like real estate do really well in inflation. In your fixed income allocation, shorten your duration. That means moving down 1 month, 3 month bonds instead of 20, 30-year bonds. Maybe dabble in commodities and gold, but the big one, stocks. That quote on the right is a great one that Mike put in the presentation. Since 1928, the U.S. stock market is up 9.8% per year, while inflation has averaged 3% per year. So you've got nearly 7% above the rate of inflation, 7% real returns Stocks, companies are really well positioned to take inflationary pressures on the cost side and pass them on and continue to expand their profit margins to produce results. So, stocks are really a good place to be in addition to those other ones we mentioned. The other thing, what can you do about this? Work with your Baird advisor and the Baird financial planners, because on the portfolio side, there are certain things, but on the cost side, that chart that I talked about earlier, if your costs are concentrated in healthcare or education and you see your rate of inflation, your personal rate of inflation above that average, there are things you can do to address that. There are things that you can do in your spending, in your planning. And we really encourage you to take advantage of the expertise that we have here. Your advisor, our planners, they're all here to address that concern. So there's plenty you can do if you're worried about it. Hopefully we have eased your mind a little bit so that you're not so worried, but that's the story. So Mike, I'll let you bring us home.
Thanks, Ross. If it's on your mind, if inflation is truly on your mind, engage with your advisor. They can test your portfolio for higher levels of inflation and how it might do. That's why Ross gives you some ideas of the things that generally work in higher inflation environments. This is important. We're trying to calm your mind about inflation, hyperinflation, these things, but you can do something about it. You can go to your Baird advisor and say, gosh, what would happen to my investments and my spending if inflation goes up? We can do that. I just want to wrap up with a quote, because I think quotes can be some of the most inspirational things to end on in a presentation like this. Jeremy Grantham was an 82-year-old investor. He's one of the kind of stalwarts of the investing community. He's got a great quote about this kind of stuff, and I'm just going to read it here. My opinion is that a big chunk of the commentating world has been freaking out about currency and inflation and debasement of the currency and the end of the world, and rack and ruin my entire investment career, which is 55 years. It's all BS. The dollar is reasonably fine. The euro is reasonably fine. The renminbi is reasonably fine. They're semi-decent stores of value. They're backed by governments who can raise taxes. They will take their currency as payment of taxes, which is absolutely critical. I think it's good enough. That is not the problem. This is an 82-year-old seasoned investor who's saying he's heard this his entire investment career. Don't let people try to scare you with crazy terms like hyperinflation, inflation's out of control, and money printing. We are here to sell you peace of mind. We hope we did. So thank you so much for coming to our little talk here. Look forward to some other events. We're gonna talk about some other things like the national debt, maybe why when the stock market's trading at all-time highs, that's not the scariest moment for it. We got lots of cool topics coming up for you. So thank you so much for joining us today, and we hope to see you soon.